Thank you for coming and being one of the hardy few to have an interest in this topic. But it does reflect something that is of great interest to me and I think will be of significance down the road for many folks here, whether you are involved on the investment side or the funding side or the journalistic side or otherwise. Let me introduce myself. My name is Don Hawthorne. I'm a partner with the law firm Axinn, Veltrop, and Harkrider. I'm based in New York. And I'm here today to address a question that I've been asked many times over recent years. I played a role in litigation coming out of the last financial crisis. I've spent a lot of the last decade plus litigating issues that came out of distressed opportunities in the financial crisis, largely relating to RMBS, residential mortgage-backed securities. That has led to waves of litigation in the U.S. and internationally that involve recoveries of billions and tens of billions of dollars on behalf of investors. I've participated in that primarily on the plaintiff side. I have recovered sums for bond insurers. I've litigated for investors. I've directed trustees. I've served as an expert witness. And based on all of that experience in a wave of litigation, which finally is now tailing off, I'm often asked the question, what is the next wave of financially related litigation going to be? Where's it going to come from? What's going to be the next RMBS? And, that question is asked by many people in many circumstances. It's asked by my clients, my investor clients at hedge funds and other places. I'm sometimes asked that question by my partners with some urgency. While I don't know the answers to all of those questions, I'm here to propose to at least explore the questions with you today. And the way I'd like to do this is to begin by talking about RMBS litigation. Where did it come from? How was it successful? What were the hooks that it turned on? What opportunities did it create for investors, for litigation funders, and others? And to use that as a prism through which to look at some of the other asset classes that exist now, which may become active fields of litigation in the event of another economic downturn. I'm not going to predict when that downturn is coming. Certainly people much wiser than myself have been predicting it regularly for the last several years. But the presumption is that it will come at some point. And what are we going to see as a distressed opportunity then? What will be the fields of litigation then? What will be the issues in play? Those are some of the things I'd like to look at today. I have to begin with a few caveats. I am a litigator. There will be many here who know far more about these subjects than I do from a technical perspective or a financial perspective. If you're a corporate lawyer who has put these deals together, you know them inside and out. If you're an investor, you may well have your own theses, which are far more developed than anything I have to say here today. So I hope that I'll be stimulating a conversation, and I look forward to hearing what you all have to say, certainly more than hearing what I have to say. Also, I have to apologize initially for a bit of a U.S. orientation to this information and this data. That's where I come from. These lessons certainly have applicability to those outside the U.S., including in Europe and in offshore areas. There have been very aggressive litigation related to the financial crisis from European institutions, and offshore entities, including funders, have had a role to play as well. So, what I'd like to talk about today is, as I said, initially we're going to talk about RMBS a little bit, and then we're going to talk about other asset classes out there and take a look at where they are now and what potential they may have in the event of another downturn. What we're talking about here are really two piles of debt corporate debt and consumer debt. And in the U.S., corporate debt piece is about 2/3 bonds and about 1/3 loans. Of those loans, roughly half of them now are what's considered to be leveraged lending. Leveraged loans are loans given to institutions which are below the level of junk bonds. So they are one of the riskiest tranches of lending out there. Traditional banks generally do not make these loans, or to the extent they do, they will syndicate them with other banks. Those leveraged loans, in significant part, find their way into CLOs, and we'll be talking about CLOs later. On the consumer side, the major piece of consumer financing is, as you might expect, mortgages, but also significant are student loans and auto loans. All of those products get securitized in the markets and distributed, and I'll be talking about those as well. Now, so here we have a picture of just sort of the magnitude of what some of these debts are. And as I said, the two bars on the right are significantly securitized now. Here we're looking at issuances, fresh issuances, both before and after the financial crisis. And there are a couple of things that are of interest on this. One is, as you see, the enormous peak in RMBS issuance immediately leading up to the financial crisis, which is unmatched by any other asset class. There was a dramatic rise leading up to that peak, and RMBS really has not recovered. And the element that was most significant in the financial crisis and most relevant for recoveries, which were so-called private label RMBS, that's mortgage-backed securities that were not backed by Fannie or Freddie, have really not recovered at all. On the other hand, you see other asset classes which continue to be of interest, some below their pre-financial crisis peaks and some higher, and we'll be talking about most of these asset classes later on today. So turning first to RMBS. What is a residential mortgage-backed security? I presume that most people here have some familiarity, but just in brief, this is a financial product which pays interest and returns principal to investors. It's funded by thousands of individual mortgage loans. And the cash flow from all of those loans, which are owned by a trust, flows into the trust and is distributed out to investors in the trust. So it's principal and interest payments on the underlying mortgage loans fund the payments out to holders of RMBS. Each RMBS is structured as an individual trust, which may hold thousands or even tens of thousands of individual loans, individual investments. Typically, the trusts are divided into tranches with the money moving through what's called a waterfall in the trust. As you would imagine, the safest tranches are at the top of the waterfall, and the ones that bear the most risk are at the bottom and get paid last. And those tranches trade differently, and people play at different levels of the waterfall. Now, why were these created? A couple of reasons. One is an RMBS structure allows you as a mortgage originator to move those mortgages off your books and to then go on and originate more mortgages. You also have the ability to diversify risk, and in theory, these products were far less risky than holding individual loans, since you could have thousands of individual mortgage loans supporting the securitization, and you could have elements of diversification in that portfolio, notably geographic diversification. Well, that did not work so well in the financial crisis, as we know. Levels of defaults increased dramatically over a short period of time, The chart on the left is prime loans. The chart on the right is subprime. The level of subprime defaults rose as high as 50% in some cases across all recent vintages. And you also notice that the vintages that occurred most narrowly, most recently before the financial crisis itself, had the highest level of defaults, indicating the declining credit quality that was going on in those years. How did this come about? Well, a couple of reasons responsible for the tidal wave of defaults. First had been really a misplaced reliance on the diversification value here, a misplaced reliance on the collateral value. People looked at the U.S. housing market and said that housing prices have never declined across the entire market all at one time. It's not going to happen here. That was false. Additionally, borrowers, lenders, the market at large looked to the collateral value as backing up these loans to the extent that credit was almost not a consideration at all. And as long as you projected steady or increasing housing prices, these continued to look like great investments, no matter how poor the underlying credit quality was. Also, what you saw was a phenomenon where the secondary markets were really driving the origination of loans, to the extent that if something could be sold into the secondary markets, the banks would originate them. The trading desks at banks really replaced the credit officer as the gatekeeper for lending. And what seems surprising in retrospect is that some of the leading executives of the originators at the time ended up saying this expressly, is basically we viewed ourselves as a conduit for the secondary markets, and as long as they bought it, we would originate it. Well, the end to this all came fairly quickly when collateral values started to fall. Suddenly, borrowers found themselves underwater in situations where they could not refinance out, and they owed far more than their homes were worth. At that point, the lending terms, the very aggressive lending terms, kicked in. Many of these loans had been issued with triggers or with kick-ups in interest rates. As the recession hit and as people lost jobs or earned less, the defaults mounted, and soon matters were in free fall. Now, many people, though, and many investors ended up doing all right in the end, and it's indeed profiting handsomely from what happened in the crisis. There were investors who lost significant amounts of money and recovered fair amounts of it. An entire industry of bond insurance was basically put out of business by the financial crisis, but they also managed to make billions of dollars in recoveries along the way. And then you had investors, opportunistic investors, distressed investors, hedge funds, who came in at the trough and purchased significant amounts of RMBS and saw litigation as a way to enhance the value of their investments, saw litigation as an investment tool, and they did very well indeed. Just to give a sense of the scale of recoveries and of the constituencies here, there were mass settlements engineered by some of the largest investors, BlackRock and PIMCO, which resulted in recoveries of billions of dollars. The total recoveries that this group who worked together have managed to negotiate exceed $20 billion. The monolines, which are the bond insurers, also recovered billions of dollars. And individual investors, hedge funds, took positions in certain trusts and directed trustees to litigate on behalf of the trust. And there were many millions of dollars to be made here at the level of a single trust, tens of millions or indeed hundreds of millions of dollars that was able to be earned by the trustee for the trust, benefiting all bondholders or all note holders in the trust, but of course primarily benefiting the hedge funds that had taken leading positions in that particular trust. So what were the bases on which these litigations pursued? What made it possible? What made possible these recoveries on this scale? The litigation hook here were reps and warranties that were given by the securitizer to purchasers of RMBS. These are some of the typical kinds of contract terms that were the real underlying hook on which these billions of dollars of recoveries were earned. The representations included that the mortgage loans had been originated according to guidelines, credit guidelines, that there had been no fraud in the origination, that the information set forth about these mortgage loans, both individually and as a group, was true and correct. And the form that this litigation took was so-called putback litigation. This was a contractual remedy that was present in essentially all these securitizations. And what it said is that if the reps and warranties were false in a way that was materially adverse to the interests of the note holders, that the securitizer would be required to repurchase the loans out of the trust. And that was the form that litigation took by and large in the RMBS world. There's also been another wave of litigation between elements in the waterfall. It's sometimes referred to as tranche warfare because different investors at different levels of the structure have competing interests. And so we've seen fights between beneficiaries. Typically, these will end up in proceedings where a trustee goes before a judge and asks for direction on what rules to apply in having that cash trickle through the waterfall, what class is going to be benefited based on sometimes extremely technical rules about how the cash gets divided, which are not crystal clear, despite the amount of work that went into drafting these securitization structures. This form of litigation is still going on. And then finally, there's been a lot of legal development on this front that's going to be relevant for any future securitization-related litigation. There's been some good precedent on what sort of harm has to be shown, that as long as the falsity of the rep and warranty increases the risk of default, that suffices to show causation and harm. The statute of limitations hasn't worked out so well in the leading jurisdictions, particularly in New York. The statute of limitations on reps and warranties runs from the time that the rep and warranty is given. So there is going to be a curtain that comes down, which is one implication of the case law as it's developed. So what have we learned in general from this experience? That, as I've just said, there is a need to act fast. There's a need to get tolling agreements in place because the statute will run. That it's also possible to work through trustees and win. These are very difficult structures to litigate with, and this is true in general, the securitization structure, is that the party that has standing to litigate on behalf of a securitization is the trustee. The trustee has absolutely no financial incentive to do so. The trustee's incentive is to limit its own liability. So from an investor's point of view, the investor has to direct the trustee, typically has to indemnify the trustee, and so it's a serious undertaking, but as the numbers have shown, it has proven to work in the past. There are also niches here that are worth real money in terms of certainly the tens of millions of dollars and sometimes hundreds of millions of dollars based on different positions in waterfalls. And there's opportunities for litigation funders who have played a role behind the scenes in much of this litigation. And the final point is one that I, as a litigator, I just feel obliged to make, is that the way that some of this litigation is played out is doubtless very different from what was anticipated by many people who were involved in structuring these deals in the first place, or for that matter, investing in these deals in the first place. And what ultimately matters for recoveries is what a court is going to rule, how a court is going to interpret documents. And so what works in court is ultimately what works. And interestingly enough, in interpreting these documents, by and large, courts did not go back to determine the intent of the parties based on extrinsic evidence. They just read contracts and decided what they meant, which is an interesting lesson, I think, for all of us involved in this form of litigation. Now, as we talked about, I'm going to go through a number of types of asset classes and try to address the issue of what does that experience about RMBS show about what could happen the next time we're in a stressed situation, the next time we have a downturn, the next time there's pressure on these outstanding major classes of debt obligations. And I'm going to start with something called CLOs, or collateralized loan obligations. A CLO is a securitization. It's like RMBS in some respects. It's a debt security. It's funded by a flow of interest payments, but those interest payments come from corporate loans, from slivers of hundreds of different corporate loans. Like RMBS, it has a tranched structure. There is an equity layer at the bottom. The equity layer takes on the risk and is paid last beyond the debt slices above it. And there are some differences in this structure, though, from RMBS. Probably the most significant difference is that there's a collateral manager here who actively manages the contents of a CLO during its life. It's the collateral manager who selects the initial elements of the CLO, the initial investments, and has the power also to manage and transfer investments during the early years of the life of the CLO. So there's active management going on here, and it's not a static portfolio as there were with RMBS. You also have an interesting interplay between equity and debt investors, which we'll talk about in a minute. So what's the purpose of these structures? Why do this? Why bundle together little pieces of hundreds of corporate loans? Well, it occasionally serves the function of getting loans off an issuer's books, as was the case with RMBS. But that's not the primary purpose of these structures, because most of these loans are purchased in the marketplace. So the primary purpose is really arbitrage to benefit the equity layer. The primary purpose of these structures is to arbitrage the difference between the flow of interest and principal repayments that comes in from the underlying corporate loans and what the structure has to pay out to its investors, to the investors in the CLO. The difference flows through to the equity piece. That's the premise for these structures, and that's why they exist. And they are interesting and important because of what the L is in CLO. The type of loans they buy are leverage loans, as I referred to at the beginning of the presentation. And leverage loans are those very risky loans, sub junk bond loans, and they are originated for many reasons, typically in connection with LBOs, in connection with recapitalizations, sometimes to permit dividend issuance, or also for debt refinancing. The typical leveraged loan is originated by a syndicate of banks with one lead agent bank, but each of the constituents have direct relationships. Each of the members of the syndicate have direct relationships with the borrower, and it's those slivers of loans or pieces of those loans which are sold off, and many of them, in fact, the majority of them today, find their way into CLOs. So CLOs have remained attractive issuance. As you can see here, the numbers have recovered from the financial crisis, and we are seeing billions, hundreds of billions of dollars in CLO issuance every year, backed by some of the riskiest loans in the marketplace. At the same time, CLOs have been resistant to default at a time when underlying corporate defaults increased in the financial crisis. CLOs really did pretty well. And so we're looking at a pretty hardy specimen of investments. So you might wonder, is there any real risk in these? Is there any real distress play here? Aren't these, in fact, a fairly safe form of investment where diversification works? Well, that is possible, but we have some issues here to consider, and one is the increasing number of covenant-light loans which are being put into CLOs, which are issued as leveraged loans. And the biggest factor here is that maintenance covenants are now no longer being required in a vast number of leveraged loans that are being issued. Maintenance covenants are the typical sort of covenant that requires a borrower to stick to a certain level of maximum indebtedness compared to revenues or compared to assets. It's the kind of covenant that you would expect to see, you expect most lenders to demand. But nowadays, we have so many dollars chasing so few investment opportunities that borrowers are getting away with these covenant-light loans in large numbers, and they are finding their ways into CLOs. And this has led to increased risks. There's certainly been an appreciation of those increased risks, where we've gone from perhaps 10% of loans in 2009, which were covenant-light, up to 80% of leveraged loans today that are covenant-light. That's a huge shift, a huge change. This is a CLO manager joked earlier this year, how can we have defaults if we don't have covenants? Well, that does raise the question, where is the litigation opportunity here? If these loans are really so covenant-light that is there a hook for litigation when they default? Or are we just inviting defaults by putting no bounds, no maintenance covenants on the behavior of borrowers? Well, there are at least structurally two levels of litigation that are possible in the CLO structure. One is the CLO itself could be suing the borrower or could be suing a syndicating bank. But the other level is of investors in CLOs. And one primary target, if things turn south in the CLO structure, is going to be the collateral manager, that party who put together the CLO, who directed its constituents. And this is an interesting issue to think about. It's an issue where there's been no litigation so far because we haven't yet seen the downturn. But collateral managers are going to be potentially in the crosshairs if we do see those downturns and we do see that rise in defaults. This is not going to be like RMBS litigation. There are not reps and warranties that are of particular significance in these deals. And in the initial structures, the individual loans are identified. So we have a different situation. In the RMBS situation, we had thousands of underlying mortgage loans. So the securitizer was obliged to make representations about the quality of those loans. Here, the individual underlying loans can be disclosed initially. So you're not going to see an RMBS type rep and warranty litigation in this area by and large. But what you may see is covenant-based litigation, because that collateral manager takes on obligations, as I said, to act in certain ways on behalf of the securitization. It is obliged to do certain things in terms of the selection of initial investments. Certain practice is in terms of the active trading of loans and the maintenance of the portfolio. And there are some hooks in the covenants that could lead and to support litigation brought against a collateral manager. There are standards of care and good faith in the typical contract. There's also serious questions about the range of fiduciary duties that the collateral manager may take on. And in any situation where a conflict of interest arises, that also can give rise to heightened duties. And a situation, for example, where the collateral manager owns the biggest piece of the equity may put his interests in conflict with those of holders of the debt. Now, at the same time, there's an interesting trend going on, which is that issuers are further weakening those covenants that restrain the activities of collateral managers, or to put it differently, are increasing the discretion of collateral managers to take many steps, including amending the terms of the indentures themselves to give themselves more flexibility in making exchanges and in managing the collateral. And it raises a very interesting question, because on the one hand, by reducing any sort of covenant or limitation, you clearly are putting some difficulty in the way of parties who may be interested in bringing claims. On the other hand, the more discretion that the manager has, the perhaps bigger hook that you have for liability as well. So it'll be interesting to see how this plays out. And I expect, if and when we see the downturn, we'll see some litigation in that area. I'd like to turn to CMBS now. CMBS are commercial mortgage-backed securities. Very similar to RMBS. In many ways, they're ultimately backed by mortgage loans, in this case, commercial mortgage loans. They have the same securitization structure. They have the same tranche structure. There are some differences from RMBS. Typically, a CMBS supports a limited number of high-value loans. There are fewer reps and warranties given, and the structure of these deals has a controlling class, which has a different sort of implications to strategy and tactics. It's a popular asset class. It has not quite recovered from before the credit crisis, but has done much better than RMBS have done. Now, there has been CMBS litigation traditionally, and what does that look like? Well, first of all, unlike RMBS litigation, it wasn't sort of a tidal wave. It's individual one-off litigation when the underlying commercial properties run into problems, and we've seen that happen from time to time, but it's a one-off situation. And there basically are three kinds of litigation, three dynamics here. You see trustees working, again, on behalf of a CMBS trust, suing borrowers or guarantors to recover on the underlying loans. You can also see trustees sometimes suing the originator and seller of the loans, and there may be representations and warranties in play. And then finally, you have conflicts of interest, the so-called tranche warfare that I spoke about, which in this case takes place between the controlling class and other note holders in the class. Now, CMBS have been traditionally a fairly low default class of investments, but that could change. And what's happening here is no secret. We're seeing severe pressures on the underlying type of assets that are held by CMBS. The decline of brick and mortar retail is a widespread structural phenomenon that's ongoing, and it's causing deterioration in many CMBS, as well as deterioration in the value of the underlying collateral. This is a story that takes place across many jurisdictions and takes place certainly in England as much as it's taking place in the States. So if the downturn happens, and if the downturn accelerates the decline of the underlying collateral, the value of the collateral, if the decline pushes those businesses that are owning that commercial space and paying the loans, if it pushes them to bankruptcy, what happens then to CMS? What is the hook? Well, there is a possibility here for litigation based on reps and warranties. And if you look at the kinds of reps and warranties that are typically present in CMBS deals, they do have a lot of similarities to RMBS reps and warranties. You see guarantees that the mortgage loan schedule was accurate and true, that the seller had no knowledge of material misrepresentations or anything that was untrue in the mortgage loan documents, that there was no breach of the underlying mortgage, that the origination and servicing practices met industry standards. Those sorts of reps and warranties have not been much tested yet in the CMBS arena. They are not too far different from the types of reps and warranties which led to enormous recoveries in the world of RMBS. So we could see, may well see more activity in the CMBS realm along these lines, if and when the downturn comes. Now, continuing our sort of march through asset classes, I'll speak very briefly about student loans. Student loans in the U.S. are much less significant from the standpoint of a distressed investment than they used to be. This is, of course, a heavily politicized asset class which creates additional uncertainty around investment. But for the past 4 or 5 years, student loans have been issued directly by the federal government and are no longer securitized by and large. There's a very small market now for privately originated and securitized student loans, but in excess of 90% of them are now held directly by the federal government, and so are not really a meaningful investment tool. There are reps and warranties around student loans that do exist, those smaller number of private securitizations, but here the guidelines are extremely weak. There are almost no guidelines and almost no loan requirements for taking out student loans, and therefore the prospect for rep and warranty litigation is not very great. Here, we don't really expect to see that. The little litigation that has occurred here has largely been tranche warfare between different holders of interests in the student loans. Typically, the equity and the debt layers are sometimes in conflict. And there's been a fair amount of litigation about that, but it is without broader consequences, really, for the student loan market. More interesting are auto loans. Auto loans are a securitization market which has increased very dramatically since the financial crisis. Despite the fact that credit terms are weakening. And what we have also seen is a rise at the same time of subprime, the percentage, the fraction of auto loans that are subprime have been increasing, both on a percentile and an absolute basis. Auto loans are subject to high delinquency rates and also increasing delinquency rates, whereas at the same time, recovery rates have been declining. Now, all of that looks like, in some ways, a fairly grim picture. What is the structure of student loans like? Well, they're much like the structure of RMBS. We again have a structure where there are thousands of small loans bundled together into a larger set of securitizations. We have parties here, both the issuers and the lenders, who are deep pockets, who look like the targets of RMBS litigation. So, are we looking at RMBS again? Well, there are some reasons to worry here about the quality of this asset. A lot of this financing is done on the car lot. It's done in high-pressure situations. It's done by people who are not credit officers but are motivated to sell cars. There have been very aggressive terms proposed. We have some of the same features, stated income and the like, which underlay many of the problems with RMBS. We have government investigations recently and ongoing looking into troubling practices in terms of auto lending, lending beyond people's ability to repay, lending based on obviously false representations, lending based on no real examination of the creditworthiness of the borrower. On the other hand, what we haven't seen so far are losses at the same dramatic level, and that's in part because the value of the collateral has held up better than the value of the housing stock did. So people are taking confidence in that collateral value. And that may be the right decision, but it also has a familiar ring to it. This is the same thing that people were saying before the financial crisis, that we've never seen collateral completely collapse in value, and therefore we don't really have to pay that much attention to the creditworthiness of the borrower. Now, there are risks, certainly, in taking that approach, where you have aggressive lending terms with underwater borrowers. Many of these borrowers will be unable cannot refinance their way out. They're underwater. They will owe more on the debt than the car is worth for its entire life. You couple that with recessionary conditions, and the risks of rising defaults are significant. If you couple that also with potential technology shocks to the value of the used car market, you see the potential for very significant losses here. And if that happens, we're back to rep and warranty territory, the familiar territory we've seen before. The reps and warranties here are thin. They are not as helpful to litigants as the RMBS reps and warranties were, but there are hooks here. That the records of the servicer do not reflect facts, which would give rise to a right of rescission. Servicing records typically tell you a lot about a borrower. They can tell you a lot about whether the borrower was telling the truth about its circumstances when it obtained the loan. There also typically are reps and warranties that a loan complied with applicable law. And there are issues here about to what extent auto lenders are responsible for determining a borrower's ability to pay and have a legal obligation to do so. That's an issue in debate, but could certainly provide another source of recovery in those contexts. Well, that's concluded my sort of quick march through asset types, and then I have a few other subjects of potential litigation I want to talk about at the end, and then reserve some time for questions. I haven't said much about the enormous chunk of U.S. corporate debt that consists of bonds, and I will only make a few observations here. Of course, the play here is largely a bankruptcy play, but what is significant here in looking at the total economic picture is the growth of some of the riskiest classes of bonds. Triple B bonds are the lowest investment grade debt. And if we're looking for what could be an accelerant in the next downturn, the proliferation of this kind of debt is certainly one possible factor. We've had an enormous growth in corporate debt over the past decade. Corporate debt outstanding has nearly doubled, and at the same time, we've seen a dramatic increase in the proportion of corporate debt that consists of triple B, the lowest grade debt. As of only a few years ago, that might have represented as little as 10% of total debt. Now it represents roughly half of corporate debt outstanding. And when companies are borrowing at this level, they are on a knife edge. If they fall below triple B, they face serious difficulties because many investors are required to invest only in investment-grade debt, and they can no longer invest in debt if it falls below the triple B level, which means that for a company, its costs of borrowing will increase dramatically when it falls out of that triple B level, and its potential for a sort of a vicious circle is certainly there. And we've seen warnings on this from many regulatory authorities recently that this is one of the weak places for the economy. From the standpoint of distress, from the standpoint of a litigator, this is, you look at this as a bankruptcy play, you look at those companies and think they are walking that knife edge, and if they fall off it, if they fall below the triple B shelf, they are going to be prospectively on the block. Finally, to take a little different detour and looking at areas of where was the next litigation boom going to come from, I want to have a few words to say about LIBOR. We all know the LIBOR story that we've recognized the difficulty in relying on benchmarks which are set on a discretionary basis by banks rather than reflect any actual market number. That has led to LIBOR being phased out. The banks will no longer be required to make LIBOR submissions after 2021. And there are replacements that are being worked on now, so far in the US. For example, SONIA in the UK, various authorities are working on fallback language, and this is a major financial change, though. But not every contract will or can be renegotiated to reflect the ending of LIBOR. First of all, there's no perfect substitute for LIBOR. LIBOR was a rate that reflected the inherent borrowing risk of banks. The replacement rates are reflecting government risk, so they're at lower levels of risk than LIBOR was in absolute terms. LIBOR also offered rates for different periods of time, 1 year, 3 year, 6 year. All the replacement rates are merely overnight rates, so there's no particular perfect substitute. Every substitute will change the economics to some degree of deals, and contracts did not anticipate, by and large, the end of LIBOR very well, and we'll get to that in a minute. But this is a situation that, again, has been recognized this year as being of significant importance and interest to the financial community. You have here the General Counsel of the Federal Reserve Bank of New York refers to this as a DEFCON 1 litigation event, the kind of comment that warms the heart of every litigator. So what do we see coming here? Well, these are contract issues ultimately, because LIBOR is a contract term. And many deals of various kinds have fallback terms, but those fallback terms do not look, when they're put under the microscope, like someone spent an awful lot of time taking serious consideration of the thought that LIBOR actually might be out of business someday. The kind of fallback terms we see are call up 3 London banks and ask for their borrowing rates. Well, once they're no longer required to provide overnight borrowing rates, I find it hard to imagine that banks are going to want to step up and do so, particularly in virtue of recent litigation history. Some deals call for fixing the interest rate at the most recent LIBOR rate, which is turning a floating rate into a fixed rate deal, which is certainly not what the parties contemplated. Some revert to prime rate, some give the lender discretion to choose a comparable rate. You can imagine the possibilities for disputes that arise there. And as I said before, there are also negotiating challenges posed by the fact that there really are no exact comparables for LIBOR. Now, so what's going to happen here? Well, some cases where there are interests on both sides in bilateral situations, in working things out, there are deals being done, and they're being done today to arrive at different post-LIBOR terms. Certainly, new securitizations, new terms that are coming out now are being designed for a post-LIBOR age, and more care is being taken now in considering what to do after that transaction. You also have, of course, a situation where you have securities with a shorter lifespan They pose less litigation risk. If debt that is going to turn over in the next couple of years is not the major concern. But there are concerns in areas where you have longer-term instruments which had referred to LIBOR, where either there's less incentive for negotiation or negotiation is impossible because we're talking about a market security, a market-distributed security. And what will those claims look like in a LIBOR world? Well, as I said, these are contract claims at their heart. So we will see claims potentially for damages. We may see claims for rescission. In the securitization context, I think we're likely to see trustee instruction proceedings. And in situations where the choice of an interest rate between LIBOR and one of these alternatives makes a significant difference for investors, we are going to, I think, see some of these things played out in court. So I began by saying that I was going to address the question of what is the next RMBS. I think one conclusion from this is that there will not be another RMBS wave of litigation. There's unlikely to be any single asset class or any single set of assets that give rise to recoveries on the scale that we saw after the financial crisis. On the other hand, what we see are a number of asset classes that are exposed in different ways and to different degrees to risks posed by an economic downturn. And we also see structures that, despite efforts to sort of clean them up after the financial crisis and avoid some of the issues and liabilities that occurred then, we see structures that have enough similarities to what went before, to the hooks for litigation in the RMBS world, that there are reasons to think that that kind of litigation will resume when distressed investors take a look at these securities if and when they are impaired in the next downturn. So I want to wrap things up in time for some questions, but I thank everyone very much for their interest in what may be an obscure subject for this audience, but I think will have bearing and interest for us all over the longer term. Thanks. So are there any questions? And I hope we can make this a discussion, because I'm sure there are folks here who have things to say and thoughts on this and much deeper knowledge than I do. So yes, sir.
Just firstly a comment. I think the idea that auto values would hold up well, I'm not saying it's your notion, but the idea that auto values would hold up well in a downturn, possibly where the secondary market for vehicles is absolutely flooded, is very concerning, and could be a big area of trouble in the future. Secondly, a question, and in relation to CLOs, what do you see disclosed in offering memoranda in relation to those covenant light issues that you were talking about?
Well, the underlying, that's a good question. So you're asking how much disclosure is there at the CLO level of the terms of the underlying loans? Is that?
The offering memoranda for the securitization itself, to what extent is that material explaining that there could be some, that there could be a prevalence of covenant-light loans originated that form part of the securitization, right. And I guess to what extent that would potentially undermine any litigation action.
Right. Well, as I was saying, there has been a trend recently towards even granting greater discretion to the collateral manager to choose different types of collateral. There are fewer boundaries on what the collateral manager does, and the implications of that would include that it has greater discretion to invest significantly in covenant-light loans. On the other hand, the questions that I've raised, and that raises a potential limitation on litigation. On the other hand, there, I think, are questions that are going to be asked about what the duties are of collateral loan officers, do they have fiduciary duties, particularly if their conduct seems to be in conflict with those of people who hold at different levels in the structure? There may be issues there, but yes, the whole framework does not provide anywhere near the type of, in my view, the type of basis for litigation that RMBS did. Yes?
I was interested to hear you call LIBOR the rate which reflected bank risk. LIBOR was fixed for many years. 2008, Lloyd's, Barclays, RBSI, HBOS have all gone tits up, and LIBOR was at its lowest ever. I sued banks for years for having fixed LIBOR and having blacked the clients. So LIBOR's been bullshit for as long as we can all remember.
I'm not disagreeing with that. I think that there were sort of two flavors of litigation that came out about LIBOR. One was active connivance among banks to move LIBOR in one direction or the other in the short term based on trading positions. But the bigger issue was suppression of LIBOR across the board at the height of the financial crisis in order to bolster the image of banks in the marketplace, which led to persistent, in effect, fixing of LIBOR at unnaturally low rates for a period of years. And that's led to some of the larger litigation in the United States, litigation which ultimately has foundered a bit for very complex resolution reasons and for reason of the judge who they were in front of, perhaps. But the underlying data strongly supports that LIBOR has been a sort of a jury-rigged a number, and that the time to move on from LIBOR is now.
Where we came in was because clients were being sold interest rate hedging products. So the theory there is that you're swapping it. So as LIBOR went down, their rates went up. Yeah. So you sort of manifestly absurd, secured. My guys could have been in at 2.5%. They were paying 9% because they got one of these hedging products. So we went, hold on a minute, you fixed the LIBOR, you pushed us down, and you were doing that too. This was a massive thing with the banks. They knew in 2008 that the rates were going to do that for 30 years. So what do? They get all their sales teams to go out and sell a pile of shit to all their clients, and so that they're locked in 5, 6, 7 for forevermore. Mm-hmm. So I'm wondering what the miserable buggers are going to do this time round, because we're going to get another fall. So what are the banks going to do to keep their income going as things fall off? So it would be interesting to see what they get up to.
It is. There'll be another trick, I'm sure, in the future. So, other questions? Yes. Or comments, I should say.
Thank you. Can you discuss why, whenever we have these conversations on the subprime mortgage issue, that no one's discussing the Community Reinvestment Act, the government-instituted push for these items from '94 on that forced the banks into this process?
Well, I've certainly heard the banks forced into the process argument, and that's one take on this. From my experience, I didn't see banks being forced to do very much. One of the first cases that I did was suing Countrywide on behalf of a bond insurer. And while I can't talk about the details of that case, I can talk about public aspects that we know about. And what we know about is that the folks running Countrywide expressly took the view that I am originating for the secondary market. That's what I'm doing. And it didn't have any solicitude for borrowers or any government requirements was not the motivating factor. The motivating factor was what the trading desk could sell. And, you know, I've seen that experience up close and personal. There may be circumstances where government pressure played a role, and obviously that's a large debate and an ongoing one, but from my own personal place of where I sat in this, I didn't see the hand of government being responsible for what took place. Yes, anything else? Anything else? Any comments? Surely someone here thinks that at least one of the things I said was way off target. I'd love to hear that. Well, anyway, I appreciate your time very much. Thank you for joining me.